Hi, this is John Zolaitis. I am the president and founder of Covitas Capital, and I recently had the pleasure of presenting an investment idea at the Klosters ValueX Investing Conference in Switzerland. I started with the provocative question for value investors that perhaps instead of looking for things that were very cheap, we should be looking for things that were more expensive. But before I get into the idea, Covitas Capital is a registered investment advisor in the state of New York. And this presentation is not an advertisement, nor is it an offer to buy or sell any security. Please consult your advisor. First, let's consider the case of Canadian discount retailer Dollarama. Dollarama went public about 10 years ago, charging up to $1 Canadian for everything in the store. Then over a series of years, it progressively introduced higher and higher price points. What do you think the result? In Dollarama's case, it was a 68% increase in sales per square foot and a 14% increase in EBIT margins, which unsurprisingly helped the stock vault to over $100 from $14 in 10 years. Dollarama is considered one of the treasures of the Canadian stock market. In contrast, let's talk about Dollar Tree, which kept its prices constant at $1 for 35 years. How do you think that turned out? We looked at a period of 20 years, and what we saw is that sales productivity and margins were actually lower than they had been 20 years ago. But eventually, an activist came in and they decided to change all the prices overnight from $1 to $1.25. This helped create an immediate boost to sales per square foot and to profitability. And then they followed this up with introducing prices at $3 and $5, which I'll talk about in more detail. Looking at the stock, when it was initially announced that the activist was agitating for these changes, shares had a nice response. But then since then, the stock's basically been range bound. Our investment thesis that the multi-year benefit to the company from progressively layering in higher price points is really just at the early stages and is underappreciated by investors. For example, here are some cooler items that I saw in a recent store visit in Orlando, Florida. These $3, $4, and $5 items could never have been sold by Dollar Tree in the past. And if you examine these or you look in the store yourself, you'll see that there's a lot of really attractive items in here that could provide a reason to go to the store. Simultaneously, on the more discretionary side, here's some Easter-related products, also at $3, $4, and $5 that the company couldn't have sold in the past. Currently, they're only about halfway through rolling out these higher price point items to the chain. We would point out that in 2023, Dollar Tree had some of the highest transaction increases within the discount store universe, suggesting customers were not put off by the higher prices. Secondly, remerchandising the store with higher price point items will have a transformative effect on the store economics. But what about the Family Dollar side of the business? If you're familiar with the company, you know that Dollar Tree has been struggling to turn around Family Dollar. And in fact, since Dollar Tree has owned Family Dollar, sales per square foot have barely budged and margins are actually much lower, with really the only improvement happening during the COVID period. Fortunately, the company has recently announced that it is undergoing a portfolio review for the Family Dollar stores. This could include closing some locations, relocating some, changing some from Family Dollar to Dollar Tree, or selling off some. We don't know yet. Which brings us to the second component of our investment thesis, that really anything that they do with Family Dollar, we believe will be a positive catalyst for the stock, with the exception of just letting it continue to lose money and burn cash. What are Dollar Tree shares worth? They have provided guidance for $10 in earnings by 2026. So based on those earnings expectations, we believe the shares could be worth between $200 and $240 a share. That assumes a modest improvement in the valuation compared to historical levels, which I believe would be justified if they were to achieve this earnings target. And based on our model, we think the target is achievable. In conclusion, you've got the Dollar Tree banner, which is undergoing a structural transformation that we believe will drive higher sales and profitability. We think this is underappreciated by the street. The Family Dollar banner, while still having troubles, is likely to be clipped around the edges or in some way reduced, which we think will have a positive effect on investor view of the stock. We think the company's target of $10 in EPS by 2026 is achievable. We also think there's upside to the near-term estimates, and we're looking at about 50 to 80% upside over a 2-year period, assuming they can hit their earnings target and modest higher multiple for the stock. That's it. Thanks very much. I hope you liked this presentation. Feel free to leave a comment below. Thanks a lot. Bye.